Good morning, students. Myself, Dr. Pratibha. I am the faculty of Department of Management. Today, I am going to give you a brief about very important topic of management accounting, that is cost, volume, profit analysis. So, cost, volume, profit analysis basically examine the relationship between the changes in the volume as well as the changes in the cost, volume, and profit. It analyzes the relationship between the total sales, revenue, and profit with respect to the total cost incurred. So basically, there are three pillars of cost, volume, profit analysis. The first one is marginal cost and equation. The second is contribution, and the third one is profit volume ratio. So we'll discuss one by one. The first one is marginal cost. So marginal cost is the net change in the total cost by adding one more or one less unit of output. Let's say we are producing 10 units. So producing 10 unit, the total amount going to be like 200 rupees. And if I add one unit, that is from 10 to 11 unit, the amount is 200 to 250. So the difference between the 200 and 250 is 50 rupees, and 50 rupees will going to our marginal cost. So in management accounting, here marginal cost is equal to variable cost. So the first pillar of cost, volume, and profit analysis is to understand what is marginal cost or variable cost. So variable cost is that cost which changes with respect to the changes in the value of output or volume of output. The second important pillar is contribution. Contribution is nothing, it is the difference between the sales and the variable cost, or we can say it is the difference between the fixed cost plus contribution. So if we're talking about the contribution, so contribution has two important elements. The first one is sale and the second one is variable cost. If we got these two elements, we can easily calculate the contribution. The third important element is profit volume ratio. Profit volume ratio is that ratio which measures the degree of profit with respect to the changes in the level of sales. सेल्स के इंक्रीज होने से या डिक्रीज होने से प्रॉफिट पर कितना इंपैक्ट पड़ता है, उसकी जब हम रेशियो कैलकुलेट करते हैं, दैट इज नोन एज प्रॉफिट वॉल्यूम रेशियो. Let's say if we are selling 200 units and the amount of 200 units is 20,000 rupees. If we are increasing the number of units and the amount of sales is 20 to 22,000, so by increasing sales from 20 to 22,000 rupees, how much percentage is profit, how much percentage of profit is increased or decreased? This ratio is to be denominated by the profit volume ratio. Coming to the fourth point, that is break-even analysis. Break-even analysis, as the name shows, it is the kind of situation under which the concern is earning no profit or no losses. It is that point where the contribution cover their fixed cost. So when we are calculating break-even point, the basically formula for calculating the break-even point is contribution upon fixed cost upon PV ratio. If we calculating break-even in rupees, so the basic formula is total cost upon profit volume ratio. Again, I'm telling you, profit volume ratio is nothing. It is the ratio between the total contribution upon to the total sales. So the formula for profit volume ratio is contribution upon net sales multiplied by 100. If we are having elements of contribution like sales and variable cost, we can easily calculate contribution. And in the statement, we don't have sales and the variable cost. The formula for calculating the contribution is fixed cost and profit. If we simply added fixed cost into the profit, the contribution can be calculated. And the last and the important element of calculating cost, volume, profit analysis is our key factor, or we can say the key elements. So the key elements here means those elements which are very important for the production, and without these elements, production cannot be made. The production element is raw material, labor, direct expenses, which can be called the prime cost. Okay, so when we inculcate these 5 elements into our cost, volume, profit analysis, we can easily help the management in taking managerial decisions. I'm repeating the 5 elements again. The first one is marginal cost. The second one is profit volume ratio. The third is contribution. Fourth is break-even analysis, and the last one is key factor. If we are adding these 5 factors into the cost, volume, profit analysis, we can easily help the management in taking the managerial decision which can the management accounting does. We can read in the definition, management accounting is what? Management accounting is nothing. It is a kind of accounting which helps the management in taking managerial decision. That's it. Thank you.